Hey you guys, and welcome back to the channel. I'm with Miss Amanda again.
Hello.
So today we are talking all about money, and we're going to be going into the specifics of what today?
All of the money. So closing costs, what you can afford. We're going into more of the details about what each of those are, how we calculate that, and how we get to the numbers that we get to.
Yeah, she's going to be going into detail of the mortgage payment, like she said, all that good stuff, and I'm going to be covering the closing costs. So if you guys have any additional questions, just let us know. I feel like we're covering everything though that we need to.
Yes.
Unfortunately, we can't do specific numbers because it's just such a vast range of possibilities and estimations that we don't want to misinform anyone or give false hope or neglect someone's dreams.
Yeah, and I think that there's also a lot that the generic numbers cover a lot, but each person is different. Each loan file is different, so we really get to the opportunity to work with customers and see if their credit profile allows for other opportunities. So we'll go over what the debt to income is. Well, what I go over is a good estimate, but sometimes you can go a little bit higher, which is good to go in detail.
Yeah, exactly. All right, well, we're gonna get started and we'll see y'all in a little bit.
Hey there, it's Amanda and Kelly again. We're here to give you another helpful hint in your home purchase. Today I'm going to be talking about how you calculate how much you can afford. So what we take a look at when we're looking at your purchase price and what you're qualified for is we take a look at what's called your debt to income ratio. What that is it's broken up into two parts. We have the front end ratio and the back end ratio. Your front end ratio is your projected housing payment divided by your total income, and that's gross income. So if you're W-2, that's before taxes. If you're self-employed, we can do an income analysis worksheet for you. But your house payment divided by your income gives us the front end. And then the back end ratio is your total debt. So that's going to be credit cards, alimony, child support, if you've got a car payment, student loans, anything like that, plus the projected house payment divided by your total income. That's going to give us your back end ratio. So typically what we like to see in your debt to income ratio is a front end of 28 and a back end of 43. Now depending on the loan program, really you do have some flexibility with that. So we can take a look at your full credit profile, and with the help of our underwriters, we can maybe get you up a little bit higher than that. But that's what we like to go off of. Now, a lot of questions can come up about what is in your housing payment. And we break that down by, we call it PITI, that's principal, interest, taxes, and insurance. So your principal and interest is what you're actually paying for in your monthly pay for the loan. So your interest on your loan and the balance that you owe on the loan. Your taxes, those are your property taxes, and your insurance is your homeowner's insurance. Now, a lot of times we have questions about, well, what about mortgage insurance? That is a different type of insurance that's required anytime you put less than 20% down on a home. There are a couple of different options on how we can tackle your mortgage insurance. We can do a monthly, include it in your monthly payment. We can do a one-time payment at closing to take care of it completely. We can do a lender paid option, and we also can finance it into the loan. So there's a lot of different ways that we can tackle those payments for you. But if you have any questions, we're more than happy to help you out and go over specific details based on your credit profile.
Hey guys, so now that we've covered the mortgage payment side of all that and how much house you can afford, how you get to that number, we're going to talk about closing costs, which is something you're going to run into at the very beginning. People are going to mention it. but it's not something you're going to actually pay for until the very end at closing. So basically the average is 2 to 6%, and this is really common across the nation. So it's probably gonna be a number between there somewhere. That's the average, and it's just based off of the loan product and the loan size. So there's no perfect answer for how much closing costs you're gonna pay until you actually get into it and we start running that loan for you. So what is included in the closing cost? Well, your down payment, of course, and this can vary depending on what type of loan you get. You know, we have 3.5%, we have 3, we have 5, we have 20. So it just depends what type of down payment you're gonna put down. That affects that number, and your lender can definitely help you with that. They're probably gonna tell you up front when you first get started with the process. And then you're also gonna have prepaids, which is your insurance, like your homeowner's insurance that you're gonna have to get a quote for your new home. Also property taxes. So we'll just put this out here. Homeowner's insurance is usually decided on by you. You'll just call around, get some quotes. You have to make sure it's an insurance quote that's going to be acceptable by your lender. And then also your property taxes. And this is just dependent on where you're going to be living. So property taxes are different in each area, and some are higher, some are lower. So these two take into a major account of how much your monthly mortgage payment is going to be. They will be put into your account and then divided by 12 months. So it's going to be part of your monthly mortgage payment. And then you have your actual closing cost, which is typically all the extras that everyone loves to talk about. So you're going to have your title expenses. And this is basically just the expenses that you're going to be paying the title company for the work that they're going to be doing to help you get the deal closed. And then you're also going to have servicing expenses, which is going to cover the cost of everyone getting the loan service for you and putting it together. And then you're also going to have loan processing. Make sure I was spelling processing right. And basically that's just covering everyone putting in the hard work to process your loan, get it clear to close, all that good stuff. And then you might also run into some discount points. Now this differs. You might see discount points, you might see origination fee, but discount points is basically something that you would be charged to buy down your rate. So let's say with your credit score and your credentials, you get a certain number as your interest rate for your loan. This can actually help you get a better interest rate on your loan if they do put this onto your closing cost fees. But some just do like an origination fee. It just depends on the lender that you end up going with. And then you get down to credits, which is the good part for you because it's money that's going to be added back to you in the plus. So earnest money is something that you come up with when you first put an offer in on a home. And it depends on the area how much this is. It could be 1%, it could be a set number like $100. It's kind of just whatever your realtor is going to put in the contract for you after you talk about it. This you put down as the safety net. So if anyone backs out of the offer, gets cold feet or anything like that, it kind of is a safety for the seller and the buyer. And but if you don't back out and you get to closing, this money gets added back into your total cost. And then you also have the appraisal, which gets added back in. So if you get to the contract, you get your appraisal done, it comes back, you get cold feet, you don't want the house anymore, you're probably still gonna have to pay for that. It's usually only credited back when you get to closing and you actually close on the house. And then out of pocket, these are things that you're gonna have to pay for with a credit card, a check, whatever you need to do before you ever get to closing. So that would be your earnest money. You have to put that down before you get to closing. But like I said, you'll get it back if you stay the way. And then also a home inspection, which is something you can do. Some people don't, but it is out of pocket. These just differ by where you're at. And then additional inspections, which would be like termites. If you want something fancy like lead-based paint inspection, anything like that, that's additional on your cost. And then also out of pocket would be the appraisal fee, but it gets added back to you at closing. And yeah, that's about it. I know it's a lot and it sounds like a lot. I mean, it's a lot, but it's what needs to be done to get you in a house and to close on a house. And yeah, hopefully that clears it up a little for you. All right, so that covers it for the day. We hope you learned something.
Lots of new info.
But we're still like trying to get new ideas for videos. So if you have a suggestion, just comment down below or find us on social media.
Yeah.
And just hit us up and let us know.
Send us a message.
Yeah, we want to get y'all knowledgeable of real estate.
Yes.
Yes. So
Sweet.
We'll see you next month.
Yes.
Bye-bye.
Bye.